literally since the get-go today. And from last night's tweet, you can see what's happened to bonds. We've had this big up move on bonds. And that's what happens following a bear flattener. If you're in a bear flattener, that's going to be a long bond trade because that's not normal. That's not normal, especially when we know that the underlying reason for the bear flattener is effectively just panic or exuberance, whichever side of the trade you were on. But you understand that this is going to correct, and this is the correction here. This is a very, very good correction right here. You can see that in the background. We've came up to the VWAP from yesterday. There's the VWAP right there. That level became the buy side, sell side for the rest of the day, as you can see in the background. Yeah, but I've been buying bonds. I've been buying bonds pretty much exclusively. There was a little top edge up here to exit and start taking some scalp sells into the bond market as well. But I like this unwind of that bear flattener from yesterday. And to me, this was a bit of a no-brainer, easy money trade for if you understand bonds, this would have been a very easy money trade for you to take last night and buy into again this morning right from the get-go. So it's been good. We've had a couple of nice trades. The other market that's been good to us this morning has been oil. We had this triple bottom on oil, which was a very easy one. Unfortunately, we never ran the stops on the third attempt at the Brent Open. So we had this triple bottom here. I was a big buyer of oil down into this area here. Never happened. And obviously all that has happened is we've came back up into these prior swing highs. We started to run into the wholesale price at 62.25s. We started to run stops, and every time we ran stops, some sellers came in every time. Look, every time. And because of that, you suddenly realize, wait a second, we're not getting anywhere with this long position. And the price obviously then sold off quite aggressively into the bottom. We gave the guys a shout to buy the 30s. Some of the guys joined me and picked up a very nice 15-tick profit and a scratch. And then we bought again into the next one. We got another failed auction into the top edge. And at that stage, it's just a case of letting it go through again, running the next level of stops at 62s, bidding back into the obvious bottom edge. If you like it, then of course you're in it. If you didn't, then of course you're not. In terms of the value, the problem we had with it was that we've got a lot of macro value, but very, very little micro. So this was the trades that were tradable in here. So we bought it once, we bought it twice, we got two failed auctions. The supply came back in behind us, and that led to that squeeze trade right there. So there was a sell trade coming back in for the squeeze. The shape of the bond markets, well, that was supportive initially, very supportive initially of that early two trades. But you can see what happened with that one. The bonds tips market collapsed behind the oil, and sure enough, the oil price had nowhere to go. And when oil prices did drop, it opened the door to the buyer coming back in at those low prints and swinging the price back off of the lows at that stage. You can see a nice, very nice, obvious skew on the crack spread and the Brent WTI right at that stage as well. What else? Well, of course, we've got the added benefit of looking at China. We can see the China in the world. You can see that they are buying of commodities at lower prices. Looking at the dollar, you can see that they were not as bullish, but certainly they came back in at these lower prints. So buying oil at the lower prints does make sense. You might be saying, but look at the amount of supply that's coming in. Yep, I can see it. But if you take a look at the background, you tell me if there's supply or not, guys. Look at the background and tell me if there's actual supply coming in. The answer is actually no, there isn't supply. There's actually demand showing up in the background here. It's not supply. And this was obviously a measure to the, well, not quite a measure, but you can see roughly how we're measuring this out. You can see if we take this low print here up into those pins, we're just coming into that pink zone just there. If we take it off of this bracket level here, you can see we're really in the meat of that pink zone right there. Really in the meat of that pink zone right there. And you can see that that's the response we've been getting off of this, bearing in mind, therefore, that this is a very important 50-line level that you should be watching for on the bounce, because you will see some selling coming in at 62.60s, of course. So when you look at these elements, you can see that we were obviously buying off of this after the sell-off, the 63.10s, but obviously down into this extra low price here. A pretty obvious trade area to do some business from, and that leaves the door open for possible selling at 62.60s. Now you can see the demand, it's not invisible, and secondly, it means that you're still taking advantage of the fact that we still have $4.50 backwardation on oil that we can lean against as well as a buyer. So I would always prefer to be buying oil if I can. Therefore, buying oil at lower prices is an absolute gift. That's why I've done it 3 times at lower prices so far. I've been bidding into these lower prints, but they're a little bit too obvious. That's what I said to the guys this morning. If the trade is too obvious, just be aware that we can take it below that price level quite aggressively. So the trade that was obvious for us this morning was the buy at 62.50s, and it says don't buy 62.50s, buy at 62.30s. The price traded 62.30s. We bought it. The price bounced off 62.30 beautifully. We got 15 ticks and a scratch, and then it went obviously through the next level to the 62.15s, and then the next level all the way through the obvious 62 level. So you're going to buy maybe the 80s and the 85s, that kind of price area. And that's exactly how the trade's evolved from that point onwards. It's been good, it's been sexy, it's been challenging, it's been all the things I like about trading. And the value is just fantastic for us just now. Buying those lower prints on oil, it's not making us great money just yet, but it's making us nice money. So welcome in, guys. I hope you're all good this morning. Not a lot of activity on S&P. We've chatted about volatilities. We've talked about bond volatilities. We'll cover that in classroom this afternoon so that you guys are aware about what we're talking about. Bond volatilities, by the way, on a macro scale basis, always deemed to be a leader of equity volatility. So we'll touch on that in classroom later on this afternoon as well. The reason is because of the way that the trade has evolved, Scott. The puts and calls is only applicable to equities, because you've got to remember that in the world of equities, there is think about Forex, for example. You mentioned Forex there. There's no such thing as a long-only Forex fund, is there? I mean, think about it. There's no such thing as a long-only Forex fund because there isn't such a thing as long, really, because one currency is long and one currency is short. So you don't get a long-only Forex fund. Forex doesn't go up or down because of inflation. Forex goes up or down because of relative value inflation against yields, against different member states. So in other words, it doesn't have a particular directional bias either. Forex doesn't have a particular directional bias like equities do. So there's an awful lot of reasons why equities are completely different from the likes of the Forex markets in the way that they trade. And the other thing is, of course, that in normal markets, volatility, and this is quite awkward at times for people to understand because sometimes it does and sometimes it doesn't, but if you've got volatility in Forex, does that mean the prices are going up or down? Well, that's difficult to answer, isn't it? Because a lot of people will say, yeah, but not really that difficult, because if there's a huge flood of money coming into the US dollar, then one would imagine that that's going to be high volatility, and that's going to drive the likes of the ABCs down. So high volatility should drive the ABCs down the same way as it drives the S&P down. Well, there's a certain element of truth to that, but that's not based around puts and calls. So there are huge differences between equities because equities are predominantly long only. The vast majority of equities are long only type products. Secondly, they are inflation linked. In other words, as equity prices have a natural upside bias which sticks around for years and years and years with the odd occasional correction. Equities are nearly always trading above their moving average, nearly always trading above their moving average on a long term. Equities, unusual is mean reversion back to the norm. So the idea of equities and Forex, completely different asset classes, and it just doesn't hold true about the puts and calls in that light as well. In terms of the way that the equities do use the puts and calls, the one thing you've got to remember is that in the world of commercial trading, equity puts and calls generally are one-sided as well. A surge in calls generally is short selling calls. In other words, the institutions sell calls as part of what's called a call writing strategy to lock in income when the market tops out and the gains to the upside are limited, but that way they can hold on to the dividend. So call writing becomes dominant inside a put and call strategy. So when we see the calls dominating, that's why the top edge of equity start to get sticky, because the holder of those calls predominantly is the dealers, and therefore they are long gamma when they don't want to be long gamma. So they sell that gamma, and that makes the top edge sticky and the price rotates. Into the bottom edge, of course, the exact opposite is true. The majority of commercial operators, pension funds and the like, they buy long puts simply to hedge, and that's why the price ends up getting sticky when we see a huge spike in puts, because people use that big spike in puts to say, well, there's plenty of hedging in place. If there's plenty of hedging in place, we can lean against that and start buying equities. That's why it rotates. So they are good for certain things, just not Forex. I mean, you can use it to a certain degree. If you're looking at the likes of the correlations between the puts and calls, rather than looking at the puts and the calls in the equity in the Forex markets, the 25 risk reversals can be quite useful. And that's things that you've probably seen from Saxo Bank before. You can see the 25 risk reversals on Saxo Bank. You can see whether they're going up or down. They have quite a strong relationship, and that's simply the pricing of the puts and the calls have quite a strong relationship to Forex prices. Secondly, we know that as equity prices go up, ABCs generally are bullish, so you can actually use the puts and calls to look at the possibility of trading Forex, but not the puts and calls in Forex, the puts and calls in equities to trade Forex and bonds. Because if you see a big surge in puts, that normally means equities have had a big sell-off, and that normally means there's a lot of gamma to buy equities with. And that means that probably the ABCs are very, very low in the water. So when you see a big surge in puts in equities on that macro scale basis, you know that there's possibly going to be a nice opportunity to buy the Australian dollar, Canadian dollar, the pound, for example. You also know that there's probably going to be a sell-off on bonds. If they've been used to hedge the equity drop, then you know that there's likely to be a sell-off on bonds. So you can use the puts and calls on equities for bonds and for the ABCs as well inside of the Forex markets. So you don't have to use the Forex markets options. You can actually just use the equity market options to find those trades.